Well, the latest economic news is out, and it was all about jobs, jobs, and more jobs, with reporting coming in from both Canada and the US. And here at home, our unemployment rate rose in June to 6.4%, and that is now the highest that we've had since January of 2022. And this number comes in higher than the market expectations, which were 6.3%. It also supports the Bank of Canada's view here that interest rates that have been having a material impact on the labor market. And that, of course, in turn then reinforces arguments for a potential rate cut to support the economy. If I look at the key details of this latest report, the unemployment rate increased to 6.4%, up from 6.2% in May. This came in above the market expectations, which had forecasted 6.3%. The number of unemployed people rose by 42,000, now a total of 1.4 million. Youth unemployment, this is an area of concern, that increased by 0.9 percentage points, now stands at 13.5%. If I look south of the border now, U.S. unemployment rate also in June, that rose to its highest level now since November 2021. That sits at 4.1%, up from the 4% in May, and above market expectations that had forecasted the rate to remain unchanged for the month. Some key statistics there. As I mentioned, the rate increased to 4.1% from 4% in May. The number of unemployed individuals increased by 162,000. That now sits at 6.811 million. Also, employment levels increased by 116,000 to a total of 161.199 million. Labor force participation rate, that also increased to 62.6% from 62.5%. And finally now, for our June employment numbers, the U.S. economy added 206,000 jobs, which is slightly below the revised 218,000 in May, but above forecasts of only 190,000. The revisions for May and April, they resulted in a combined decrease of 111,000 jobs from the previous report. Still shows a strong market, but a bit of a cooling market as well. Some key stats for this report: jobs added in June were 206,000, healthcare added 49,000, and social assistance was up by 34,000 jobs. Construction also rose by 27,000 construction jobs. Now, on the downside, retail trade lost 9,000 jobs, manufacturing was down 8,000 jobs, and professional and business services were down about 17,000 jobs. So overall, if we look at the impact of this in a nutshell here, we see that both Canada and the US are seeing rising unemployment rates. But the underlying job markets, or the dynamics of these, show different economic trajectories that we're on. Here at Canada, the Bank of Canada may need to consider some further rate cuts to stimulate growth. Whereas if we look in the US, they may continue with more of a cautious approach to monetary policy in that ongoing effort to balance growth with inflation control. Also here at home, potential rate cuts, that might stimulate the economy, which would be good. We could use that, but it also might reignite inflation if it's not managed carefully, and obviously there's nothing good about that. The U.S. does face similar risks with that need to balance job growth with inflation control. Now, from a business confidence perspective, higher unemployment rates here, that may dampen business investment in both countries, especially if these economic uncertainties persist. And finally, a look at housing markets here. Obviously, rising unemployment could affect the housing markets negatively, and most notably here in Canada, where the affordability of housing is already such an issue. It's been a very rocky time for Canada's second largest bank over the past year or so, with a lot of attention being focused on their compliance-related issues. And new news out, which is sure to add some intrigue to the story. An internal TD Bank memo says that its chief compliance officer, Monica Cowell, has left the company in the middle here of all these critical updates to their anti-money laundering controls. Now, Cowell was instrumental in developing the strategies to mitigate the regulatory compliance risks that we've seen recently. She left the bank on July the 2nd. The bank has appointed Erin Morrow, who was previously Deputy Chief Compliance Officer, to take over Cowell's role. Morrow joined TD in January from Citibank, and she brings over 20 years of experience with her there from compliance, audit, and risk management. So hopefully she can step in and do a competent job with that. TD has been working so hard lately to fix the deficiencies that they have in their regulatory compliance management program after Canada's banking regulator, OSFI, they had flagged some gaps during a recent assessment. And the bank, of course, is also under investigation by U.S. regulators and the Department of Justice for weaknesses, failures in its anti-money laundering procedures in its operations there. I have seen reports of analysts who are estimating potential penalties in this case as high as $4 billion, which could obviously limit TD's expansion in the US, which is a key growth market for them. Now, the compliance program itself, this includes the anti-money laundering controls, and it is vital for financial institutions as part of their risk management program. And TD they have to here do whatever it can to ensure that these controls are strong enough to make sure that it complies with the various international regulations, which would safeguard the bank's operations, but probably most importantly here, its reputation, which obviously has suffered lately. Now, TD Bank, full disclosure, is one of my largest holdings. It's one of my top holdings. And obviously, I'll be keeping an eye on how these developments unfold, as they will have a huge impact on TD's direction, the strategic direction, and market operations, and of course, importantly, as an investor, its future performance. A bit later this year, Harvest ETFs will mark their 15th anniversary as a company. And since they began offering income ETFs, they've paid out nearly $1 billion in total distributions. And I will put a link in the description of this video to their About Us page, which includes the total distributions and more details on that. Well, now they've just announced the latest round of distribution increases as part of their core ETF's total return to unit holders. The new monthly cash distribution amounts are going to take effect for the July 31st record date, with a date payable of August 9th, 2024. So why are they doing this? Well, the increase to the distribution amounts, this is intended to provide two things: a reasonable and sustainable distribution yield for the unit holders of their ETFs, at the same time, critically, to continue to provide the opportunity for long-term capital appreciation through exposure to the investment mandate of each of the underlying ETFs. Now, Michael Kovacs, he is the Harvest president and CEO, and he says, Harvest takes pride in our ETF's long-term record of steady month cash distributions, and we are pleased to announce these increases as an important part of the ETF's total return to unit holders. Later in 2024 will mark the 10th anniversary of the Harvest Healthcare Leaders Income ETF, HHL. Over nearly 10 years, HHL has paid out $450 million Canadian of steady monthly cash distributions as of May 31st, 2024. So if you are looking for cash flow for your portfolio, this is a great opportunity. Again, I will put a link in the description of this video. NVIDIA's incredible rally might have hit a ceiling. At least that's according to New Street research analyst Pierre Ferragu. And he says that after a roughly 150% gain so far this year, and on top of 240% last year, he has actually taken the step of downgrading the AI chipmaker from buy to neutral. And he believes that the stock is what he calls getting fully valued, and is cautious about expecting more big gains unless there is a clear positive outlook beyond 2025. Now, Ferragu does say that while NVIDIA's franchise quality is still very strong, there is a risk of derating if the current outlook stays the same. Now, obviously, NVIDIA has been a star performer of late. It has added almost $1.9 trillion to its market cap this year alone. They briefly became the world's largest company. But although the analysts' downgrades are rare, we may be seeing somewhat of a valuation concern here. I wonder if this is maybe the start of something more to come. Currently, NVIDIA is trading at more than 22 times its estimated revenue for the next year, and that makes it the most expensive stock of the entire S&P 500 group. In this case, New Street set a one-year price target of $135 for NVIDIA. That compares with the $128 and change that the stock is trading at this morning. Now, he also highlighted other companies in the semiconductor space. He is optimistic about Advanced Micro Devices, AMD, and also Taiwan Semiconductor, and he calls them the best names to own in the group, offering strong upside in both our base and high scenarios. And he also noted that Broadcom, Arista Networks, and Micron Technology are still attractively valued amongst the other AI-exposed stocks. He also says that these companies are continuing to present promising investment opportunities thanks to their solid fundamentals and potential for future growth. Earnings season kicks off again this week, and with so many stocks that are trading at these high valuations we're seeing, we will be watching the earnings reports like a hawk. And the poll question this week in our Pulse newsletter is, will corporate earnings be able to sustain the stock market rally in 2024? Now, so far the results are neck and neck, and we're interested to see what you have to say. You can click on the QR code on the screen to voice your opinion. Also, did you know that you can listen to all of our YouTube videos in podcast form? You can click on this QR code to subscribe with your favorite podcast provider. Hudson's Bay has announced it will be buying Neiman Marcus for $2.65 billion US. And this is a move that has been circulating in the rumor mill for a little bit now. This will see Neiman Marcus join Saks Fifth Avenue and Bergdorf Goodman under a new umbrella entity called Saks Global. So what is happening exactly in this case here? Well, Hudson's Bay, they are grouping Neiman Marcus with other high-end brands into the Saks Global label. It will also be positioning it as a collection of international luxury names. Now, in a twist that has caught my attention here, Amazon and Salesforce will also be part of this deal. Now, Doug Stevens, he is a retail analyst at Retail Profit, and he says Amazon has been trying to beat down the door of luxury for at least the last 6 to 7 years. They've been making a really concerted effort to try to crack the luxury market, but have been unsuccessful. The marrying of HBC, Amazon, and Salesforce makes the deal interesting to me. Now, this acquisition, it also follows other recent strategic shifts at HBC. We've seen the closure of Home Outfitters, also the sale of Lord & Taylor. Now, on a personal note, luxury retail has never really been my thing, but I always marvel when you travel at the airports around the world. They are full of these high-end retailers, and I never would have believed that people would actually spend their time, between flights shopping for expensive clothing, for expensive souvenirs. But obviously they are, or these stores wouldn't be there. If you have thoughts on this, you can go ahead and enlighten me as to why these stores are there, why they fill these aisles, by leaving a comment below. Look forward to seeing what you have to say. If you're not already subscribed to our Pulse newsletter, I'm going to make that very easy for you to do. I will add a link to the description of this video. Also, I am here Mondays and Wednesdays with this report. Thank you very much for watching this video. We'll see you on Wednesday.